Hey folks, what's up? This is Paul Price with Retire Rich with Real Estate, and today I want to talk to you a little bit about taxes and 3 common myths. Hi, Paul Price here with Retire Rich with Real Estate, and today I want to talk to you a little bit about taxes. You know, what separates the rich from the poor a lot in this country is their understanding of taxes. They understand how the tax code works, how it's going to affect their income, and how to avoid taxes legally and necessarily so that they're able to keep most of their wealth and reinvest it and do what they want with it. So, you see people like Jeff Bezos of Amazon. Amazon paid like 0 taxes, made like $16 billion last year. Those people know how to legally avoid paying taxes using deductions and all the intricacies and loopholes that are built into the tax code in some ways to help rich people. So, the more you know about taxes, the better. But today I'm going to talk about 3 common myths that I'm hearing all the time about taxes. Myth number 1. One of the more common myths I hear all the time is people telling me how because I'm a business owner, I can write everything off. If I buy something, a piece of equipment or a vehicle or whatever for my business, I get a write-off.
Stereo now?
Well,
It's a write-off for them.
How is it a write-off?
They just write it off.
Write it off what?
Jerry, all these big companies, they write off everything.
You don't even know what a write-off is.
Do you?
No, I
they
don't.
tend to think that's like a dollar for dollar 100% tax credit that I get, and that's not exactly how it works. You do get to write off things when you are a business owner, and it's one of the benefits that rich people use to save money on their taxes. But here's how it really works. Let me give you an example. Let's say you have a side hustle that you do, and you make about $10,000 a year doing this little side hustle. And you use a computer for this side hustle. So you want to buy a new computer, and you're going to spend, let's say, $1,000 on this new computer. So you're going to make $10,000 this year, and you're going to spend $1,000 on this computer, and you're going to use that as a business deduction. And that's legal. You can do that. So at the end of the year, you're going to have your $10,000 income minus your $1,000 deduction for your computer purchase, and that's going to leave you with a taxable income of $9,000. Now let's just use, for example, let's say you're in a 25% tax bracket. Let's make the math easy. $9,000 times 25% is $2,250. So you'd pay $2,250 in taxes on $9,000. While if you had paid on the full $10,000, you would have paid $2,500. That's a difference of $250. So you can see that the $1,000 that you spent on the computer was a deduction, and you only got to save 25% of that deduction. So because that's your tax rate, so it's your deductions at the tax rate is what is the savings that you get. So if you think about that, you're not going to go out and spend $1,000 to save $250. That doesn't make any sense. The only way that makes sense is if you have to have the computer. If you need to purchase a computer anyway, then you're actually getting the computer and you're letting the government pay for part of it, because they're going to give you $250 as a deduction on your taxes. So your net pay on that computer is like $750. It bothers me when people say you're just buying that so you'll have a write-off, or you're just donating that money so you'll get a write-off. That's not really true. I mean, because you're not going to get that much back of it. You're going to get a portion of it back. So if you donate $1,000 and you get $250 back, you still lost $750 that you would have had as income. So you are donating real money. It's not like you're donating $1,000 and you get to take $1,000 off your tax bill. That's not how it works. Same thing is if you're buying equipment and you spend $1,000, you're not getting to get that equipment for free. I mean, you're getting a deduction, but you're not getting all of it off. So I think that's a common myth. There's a lot of people that really think that. Myth number 2. When you get a larger than normal paycheck and it throws you into another tax bracket, many people think that you just paid taxes at that higher tax bracket and you don't get it back. That's not how that works either. This would happen a lot in commission sales. I was in commission sales for years, and we would get a check that was for a big commission. You'd make a $2,000, $3,000 commission, you get a check, and you get this huge check for the week or for the bi-weekly or monthly or whatever it is for that time period that you get paid. And let's say if it's for the week, you get a huge check and you're taxed at this high tax rate, and they have this huge withholding on that one check. The reason for that is the government says that when you make this amount in a week, let's say you get a check for $3,000 and it's a commission check, and you make it in that week, they assume that you're going to make $3,000 a week for the whole year, and so they'll tax you accordingly because they want to withhold enough to make sure that you are withholding enough money to pay the taxes at the end of the year. Unfortunately, in a commission job, that's usually not the case. You get these commission checks sporadically throughout the year. So what happens is you get hammered on these big checks that you get, and then the little checks don't get hardly taxed at all. But at the end of the year, it all washes out, because at the end of the year, whatever your income is determines your bracket, and then go back and adjust everything down to that level. And if you've paid more than that, then you just get it as a refund at the end of the year. This happens in the hourly world too. When people go working overtime, which is time and a half or triple time, there's some people, like my grandfather was one, he didn't like to work overtime because he would say, I work overtime and the government just takes more of my money out of my check. And they put me in another tax bracket and it takes more money out of my check, which is true, it does. But he didn't realize that at the end of the year, he's going to get all that back. And you try to make him understand that, and he didn't quite understand that concept. But so understanding how the tax system works makes you understand that you are getting temporarily taxed at this higher level, but you're going to get it back at the end of the year through the refund. Myth number 3: when you're bumped into another tax bracket, you do not pay that rate all the way back to zero. You don't pay it retroactive. And many people don't understand that we had a tiered tax bracket system. There are 7 brackets starting at 10% going all the way up to 37%. Now what you have to make to fall into each bracket depends on whether you're single, filing as head of household, you're filing as married in joint return, or married filing separate returns. So depending on what your situation is, that determines what level each bracket is for you. So it is kind of complicated, but let me give you a simplified example. And these numbers are totally made up just for this example. But let's say you're making $50,000 a year, and for example, we're going to make up a bracket, and we're going to say it's a 25% bracket below $50,000, and it's 35%, let's say, above $50,000. And let's say this year, instead of making $50,000, you made $55,000, which puts you into the 35% bracket. Now, you're not paying taxes at 35% on the whole $55,000 you earned. You're only paying 35% on the $5,000 that you earned over $50,000. On the $50,000 and below, you're paying 25%, which in this case would mean you would pay $12,500 on the $50,000, and you would pay 35% on the $5,000 that you made over the $50,000. And that 35% of $5,000 is $1,750. So you would pay that plus the $12,500, which is 25% of $50,000. So you would add those two together, and that would be your tax bill. So that's how your taxes work. Thanks for watching. If you enjoyed this video, please press the like button. And if you'd like to see more, subscribe to our channel. And don't forget to hit the bell for notifications so you know when we release new videos. And if you'd like more information on real estate investing, go to retirerichwithrealestate.com. Until next time, I'm Paul Price, teaching you how to retire rich with real estate.